Folks always ask me the same thing, Jesse. How do you know when a breakout's coming before the rest of the crowd sees it? Well, that's what we're going to talk about today. 3 clues that tell you a breakout is about to start. And if you remember the previous video on why volume confirms every breakout, this one will feel like the natural next step. Because once you understand what confirms a move, the next question is, how do you see it coming before it happens? Now, trading is a waiting game, not for the impatient, not for the gambler. Most folks lose money because they want to act before they see anything. They can't stand to wait for the tape to tell the truth. But when you learn to read the market like a book, you start to notice small signs that whisper before the crowd shouts. That's where these clues come in. The first clue is something I've seen time and again since my bucket shop days: tight price action. When a stock that's been moving loosely suddenly starts to coil up, making smaller and smaller moves each day, that's not weakness. That's pressure. That's a spring being wound tight. You can almost feel it. Ask yourself, when was the last time a market stayed quiet for long? Never. It's always building towards something. And that tightening of range, that calm before the storm, is your first sign that the big move is getting ready. But here's what most people get wrong. They see that tightening and they jump in, thinking they're early. I used to do that too, back when I thought I could outsmart the tape. The truth is, the tape doesn't care about your opinion. It'll shake you out 10 times before it finally moves. So don't chase. Watch. Let the market prove itself. When it's coiling, it's not your job to act, it's your job to observe. The second clue comes from something that can't lie: the behavior of volume. You remember from our last talk how volume confirms a breakout. Well, this is where you see the seeds of that volume before it explodes. When the stock's price is still moving in that tight little range, take a look at the volume bars. They'll start to show a rhythm, quieter on pullbacks, a little heavier when the price pushes toward resistance. That's not random. That's accumulation. Somebody's buying, but they're doing it quietly. Ever wonder who's on the other side of your trade? It's not luck. It's the professionals, the ones with patience. They're not guessing. They're loading up while the crowd is bored. That's the time to pay attention. When you start to see volume perk up on up days and dry up on down days, that's your clue number 2. The insiders are preparing for a move, and when it comes, it'll look sudden to everyone else, but you'll know better. Now, the third clue, and this one took me years to learn, is the test of support. Before a breakout happens, the market likes to make one last check to see if the weak hands are gone. It's like a general testing the line before a battle. The price dips, sometimes sharply, right back into support. The amateurs panic. They sell out. And then the stock finds buyers again and bounces hard. That retest, that shakeout, is the market's way of cleaning the slate before the real move begins. Tell me, have you ever been that trader who got shaken out only to watch the stock take off right after you sold? Everyone has. I've done it more times than I care to admit. That's why I learned to wait for the reaction. The shakeout doesn't mean failure. It means the test is underway. And when the price snaps back and holds above that level, the market has spoken. That's the clue that tells you the path is clear. Now, these 3 clues: tightening range, volume behavior, and the support test, they're not just signals. They're part of a trader's education in patience. You can't rush them. You have to live with the chart long enough to feel its rhythm. Trading isn't about predicting, it's about preparing. The breakout, when it comes, will take care of itself if you've done the watching first. And here's where mindset enters the picture. Most traders are slaves to excitement. They see every uptick as opportunity, every downtick as danger. But the professionals, the ones who last, they treat both the same. Calm, disciplined, detached. You've got to learn to see the market as a living thing, breathing in, breathing out. Every contraction is setting up the next expansion. Every pause hides a story. The clues are always there if you're patient enough to listen. Do you remember how we said in that last video that volume is the truth teller? Well, These clues we're talking about today are the whispers that lead up to that truth. The market starts hinting before it speaks loudly. So, when you catch those hints, the tightening, the quiet accumulation, the retest, you're not predicting the future. You're reading the present more clearly than the rest of the crowd. Let's talk for a second about the mindset behind waiting for these clues. Most people in this game want action. They think trading means being in the market every day. But I learned long ago money is made by sitting, not trading. It's made by waiting for those rare moments when all the signs line up. You can spend weeks watching a chart that looks dull as dust. Then one morning, it all comes together. The range breaks, the volume swells, the price surges. That's when you act, not before. Ask yourself, are you the kind of trader who waits for the market to invite you in, or are you the kind who barges in uninvited? Because the difference between the two is the difference between surviving and vanishing. When I watch a chart forming those 3 clues, I don't rush to buy. I wait for confirmation. I let the price show me its intent. You can't outguess it. You can only align yourself with it. Every big win I've ever had came after long stretches of waiting, of doing nothing but watching those patterns tighten and volume shift just slightly before the big move. The market rewards discipline, not excitement. It punishes curiosity that turns into impatience. You've got to train yourself to see these early clues not as signals to act, but as signals to prepare. Build your plan. Set your levels. And when the breakout finally happens, when the tape confirms what you've been waiting for, then, and only then, do you step in with conviction. You see, most traders never learn that the real money isn't made during the breakout, it's made in the waiting before it. In that quiet zone where nothing seems to happen, but everything is actually building. That's the place where experience shows itself. So, when you look at a stock next time, don't just stare at the candles. Ask yourself, is the range tightening? Is the volume telling a quiet story? Has it tested support and survived? Because if all 3 are there, you're looking at a powder keg waiting for a match, and the day it lights, you'll know not because you guessed, but because you read the signs the way an old trader reads the tape. Professional traders buy during boredom, not excitement. That single line holds more truth than most trading books written in a lifetime. You see, the crowd loves excitement. The flashing lights, the sudden spikes, the news headlines that make them think they're about to witness the next big thing. But that's not where real money is made. Real money is made in the quiet times, when nothing seems to be happening and everyone else has already lost interest. That's when the smart money moves in quietly, deliberately, without fuss. The amateurs can't help themselves. They crave movement. If the stock's not moving, they think it's dead. But the seasoned trader knows that quiet markets are where opportunity begins to take shape. It's like watching a field before a storm, still silent, heavy with potential. You can almost sense it if you know how to look, and that's the difference between excitement and patience. One burns fast and dies out. The other waits, studies, and strikes when the odds have tilted heavily in its favor. Ask yourself, how many times have you bought a stock because it was running, because everyone was talking about it, only to watch it collapse right after you got in? Every trader has done it. I did it more times than I care to admit when I was young and full of pride. I'd chase excitement like it was a sure thing. But the market has a cruel way of teaching humility. Every time I thought I was catching the next big wave, I was really just feeding the exits of the professionals who had already loaded up during the quiet phase. That quiet phase, the boredom, that's where they do their work. Picture a stock that's been forgotten, trading sideways for weeks, maybe months. The volume dries up. The daily range tightens. Retail traders move on to something flashier, but behind the scenes, the professionals are watching. They start accumulating small positions, buying a little at a time, careful not to attract attention. Their goal isn't to make the price move yet. Their goal is to own enough before it moves. That's why you'll see those subtle upticks in volume on up days, small clues that someone's interested while everyone else is asleep. The beauty of this approach is in its simplicity. Professionals aren't trying to predict the next headline. They're reading the tape, feeling the rhythm, waiting for the moment when the balance of supply and demand shifts quietly in their favor. They know that by the time the public notices, the easy part of the move will already be over. And it always happens the same way. First comes the boredom, then the quiet accumulation, then the sudden explosion that shocks the crowd, but surprises no one who's been paying attention. There's a psychological side to this too. Most traders can't handle boredom. They think being out of the market means they're wasting time. They need to feel involved, active, busy. But trading isn't about activity, it's about waiting for the right activity. Professional traders learn early on that doing nothing is sometimes the hardest and most profitable thing you can do. The boredom phase tests your discipline like nothing else. It whispers, maybe you're missing out, maybe you should trade something else. But the ones who can ignore that voice and stay focused on the setup forming beneath the surface, those are the ones who catch the move before it becomes a spectacle. Ever notice how when a breakout finally happens, everyone rushes in at once? The news channels start talking, the social feeds light up, and suddenly every beginner trader wants a piece. That's excitement. That's where the professionals quietly sell into strength. They're not chasing anymore, they're cashing in. Their work was done long before the crowd arrived. They bought during boredom. They bought when nobody cared. The reason this works is simple: markets are emotional machines driven by human behavior. Most people act on emotion, not reason. When the market's quiet, they lose interest. When it's loud, they lose control. Professionals flip that behavior upside down. They use the quiet to prepare and the noise to distribute. They know that excitement is the enemy of discipline, and boredom is the friend of opportunity. And let me tell you something, boredom isn't easy. It feels uncomfortable because it goes against every instinct a trader has. We're wired to seek action. But the best trades I ever made came after long periods of nothingness. Those were the setups I had to wait for, the ones that tested my patience and conviction. When they finally broke out, I wasn't guessing. I was ready. Now, how do you train yourself to see boredom as opportunity? You start by changing your mindset about time. Most people treat time as a cost. They think if they're not trading, they're losing. But professionals see time as a filter. It weeds out the impatient. The longer a setup takes to form, the fewer people are left watching it. And by the time the real move begins, only the disciplined remain. That's where the edge lies. You also have to learn to love the quiet parts of the chart. The sideways grind, the uneventful candles, the moments where volume shrinks and price drifts. That's where the market hides its next story. Look closely, and you'll see the clues: the occasional high volume up day, the subtle higher low, the faint tightening of range. Those are the footprints of accumulation. It's not glamorous, but it's real. Professional traders have a saying: buy when it's hard to buy, sell when it's easy to sell. And it's true. It's hard to buy when a stock looks dull. It's hard to buy when nobody else is talking about it. But that's exactly why it works. There's no competition, no noise, no hype. Just value quietly forming before the crowd notices. By the time the masses arrive, it's already too late. Think of boredom as camouflage for opportunity. The market doesn't reward attention seekers, it rewards observers. If you can sit through the quiet, you'll see things others don't. You'll spot the early accumulation, the base forming, the signs of life that only patience reveals. And when the excitement finally returns, you won't be reacting, you'll be realizing profits from a position that was built long before the crowd even looked your way. Price action must prove intent before commitment. That's one of those trading truths you don't really understand until the market teaches it to you the hard way. Every trader begins by wanting to believe something about the market. They see a setup, a pattern, a signal, and they convince themselves they already know what's going to happen next. But the market doesn't care what you believe. It doesn't move because you think it should. It moves when it's ready, and it proves its intent through action, not through your expectations. When I say price action must prove intent, what I mean is simple. Don't commit your money until the market confirms what you think you see. Because until then, it's all speculation. A chart can look perfect 1 minute and betray you the next. The difference between a professional and an amateur isn't who's right more often, it's who waits for proof before committing. Professionals let the market show its hand. Amateurs guess at it. Think about a breakout setup. The crowd loves the idea of getting in early, of buying just before the move. It sounds smart, anticipating the breakout, they call it. But how many times have you seen that anticipation turn into frustration? The stock moves a little above resistance, teases you with a few green bars, and then collapses back into the range. False breakout. That's what happens when you buy before the market proves its intent. You acted on the hope of a move, not the evidence of one. The evidence comes through confirmation. You need to see not just a breakout, but a breakout that sticks. A move supported by volume, by momentum, by follow-through. You need to see the market behaving as if it means business. That's what I call proving intent. It's the difference between a flicker and a flame. A flicker is noise, a flame sustains itself. Price action that shows intent will not just poke through resistance, it will hold above it. It will attract volume. It will tell you through its behavior that the market agrees with your idea. Ask yourself, do you want to be right, or do you want to be profitable? Because those two don't always come together. The trader who wants to be right commits before proof. The trader who wants to be profitable waits for confirmation. Waiting doesn't make you late, it keeps you safe. You can always enter a trade that's already proving itself. You can never recover easily from one that betrays you right after you commit. The market is full of traps designed to test this very principle. False breakouts, fake-outs, head fakes, whatever name you use, they all serve one purpose: to lure impatient traders into committing before price has proven intent. And those traders are the ones who provide the liquidity for the professionals to accumulate or distribute quietly. The smart money waits for proof, and then rides the wave created by the amateur's mistakes. Waiting for price to prove itself isn't just about chart patterns, it's about mindset. It's about humility. It's admitting you don't control the market. You don't decide when it should move, you only decide how you'll respond when it does. That humility protects your capital. It stops you from fighting a trend that hasn't yet declared itself. It teaches you to respect uncertainty instead of pretending it doesn't exist. Think back to those quiet accumulation phases we talked about before, the boredom zones where nothing seems to happen. That's where proof begins to form. You'll start to see small signs, higher lows, subtle increases in volume, pressure building near resistance. But that's still just potential. The proof comes when price acts with conviction, when it breaks a level and stays there, when it refuses to give back its gains, when every dip gets bought and every rally finds support. That's the market proving its intent to move higher. The same applies on the downside. Before you short, let the market show weakness, not just in price, but in how it behaves. Watch for failed rallies, lower highs, volume on down days that outpaces volume on up days. Those are signs of intent. A professional trader never assumes a move. He waits for it to demonstrate strength or weakness. Because price doesn't lie. Everything else, the news, the opinions, the forecasts, those are distractions. Price and volume are truth. Most traders lose because they want certainty before the market gives it. They want to feel right instead of be right. But the only certainty in trading is that nothing is certain until the market proves it. Every successful trade starts with observation, not prediction. You read, you wait, and when the tape shows conviction, that's when you step in. Let me ask you something. How many trades have you taken that you knew were going to work, only to watch them fail? And how many times have you hesitated on a setup, thinking you might be too late, only to see it run far past where you thought possible? That's the lesson. The first trade lacked proof. The second one had proof, but you didn't trust it because it already looked too obvious. Yet the market rewards the obvious when it's backed by conviction. The amateurs think confirmation means missing the move. The professionals know confirmation means validating the move. There's a world of difference. A move that's real will always give you another chance to enter. A false move won't. That's why patience is the trader's sharpest edge. It's not the indicator, not the pattern, it's the willingness to wait until the market shows what it intends to do. Sometimes that proof comes quickly. Sometimes it takes days. You might see a breakout followed by a tight consolidation right above resistance. That's a sign of intent. It's the market saying, "I'm not done yet." But if the price breaks out and immediately collapses back below that level, that's the market saying the opposite. Listening to those signals, that's what separates skill from gambling. When you start trading this way, you begin to see the market as a conversation. The price speaks, and your job is to listen. When it whispers uncertainty, you wait. When it speaks with conviction, you act. That's what price action proving intent really means. It's the language of the market, showing you what side has control. And here's the thing, when you finally learn to wait for that proof, trading becomes quieter. You're no longer chasing every move. You're no longer reacting to noise. You're simply waiting for the market to say, clearly and confidently, that it's ready to move, and only then do you step forward with your commitment. Volume patterns whisper before the breakout shouts. That's a line every trader ought to keep written somewhere near their screen. The price shows you what the crowd is doing, but the volume shows you who's doing it. The truth of every breakout begins long before the chart explodes. It starts in the quiet fluctuations of trading volume, the subtle shifts that tell you smart money is moving in while the rest of the market is still asleep. If you can learn to hear those whispers, you'll never again be surprised by the breakout that came out of nowhere. The average trader only looks at price. They see candles and lines and shapes, but they miss the story beneath. Volume is that story. It's the heartbeat of the market. When a breakout happens, it's not magic, it's the natural result of accumulation and preparation that showed itself in volume days, or even weeks earlier. You just have to know what to look for. Most people think volume only matters when it spikes. They wait for the big surge, the obvious signal. But by then, the move is already underway, and the professionals have already built their positions. The real clues come earlier in the small, consistent changes in volume behavior that show interest growing quietly. When you see volume pick up slightly on up days but dry out on pullbacks, that's not random noise. That's a whisper. That's demand strengthening under the surface. Ask yourself what happens when demand slowly outweighs supply. Pressure builds. Prices begin to tighten, but they don't fall apart. Sellers dry up, buyers start leaning in. It doesn't make headlines yet, but it's visible if you watch closely. Those quiet periods of asymmetrical volume, more activity on up days, less on down days, are where accumulation hides. The pros don't want you to notice. They buy in silence. They spread their orders over time. They make sure the price doesn't run away before they're ready. You'll often see this pattern right before a breakout. The stock moves sideways in a tight range. The candles look dull. The crowd calls it dead money. But look below the surface, the volume tells another story. There's a rhythm to it. When price nudges up toward resistance, volume slightly increases. When price drifts back down, volume fades away. That's not a coincidence. That's control. That's accumulation. I used to ignore volume when I was starting out. I thought it was secondary. I focused on patterns, signals, indicators, all the flashy stuff that makes you feel smart. But the longer I traded, the more I realized that price can deceive, but volume rarely lies. A move with real backing has life in it. It breathes through its volume. You can almost feel when the market's preparing for something. The chart might still look flat, but the volume pulse starts to quicken. It's the market inhaling before the breakout exhale. Now here's something important. Sometimes the volume whisper is not just about increase, but about silence. When the market gets eerily quiet, when volume falls to abnormally low levels, that's also a clue. It means uncertainty. It means exhaustion. Sellers may be running out of energy. The quiet can be just as telling as the noise. Because when volume dries up to nothing, it doesn't take much new buying to push prices up. That's how many breakouts begin not with a bang, but with a whisper of imbalance that builds into momentum. Think of volume as your early warning system. It won't always tell you when exactly the breakout will happen, but it'll tell you if one is likely. The story goes like this. First the quiet accumulation, then the tightening of range, then the volume begins to perk up, just a bit, not enough to attract the crowd, but enough for the observant trader to notice. And then one day the dam breaks. The breakout bar comes with heavy, undeniable volume. The crowd calls it a surprise. You call it confirmation. Do you remember what we said earlier about price proving intent? Volume is how it whispers that intent beforehand. Before price ever moves convincingly, volume starts to shift. That's why watching it carefully matters more than drawing fancy lines on your chart. A resistance line by itself is just a guess, but a resistance line with rising volume pressure underneath, that's a clue. That's tension. That's the setup before the release. Most traders can't sit still long enough to notice these small changes. They're always chasing the next active chart, the one already moving. But the big money is made by those who can read the quiet signs and position themselves early, not by predicting, but by preparing. You don't have to guess when a breakout will happen. You only have to recognize when the groundwork is being laid for one. Volume tells you that. It's like seeing footprints before you see the runner. Ever wonder how professionals seem to know before the crowd? They don't know the future, they just pay attention to what the tape is already saying. Volume speaks softly at first. It tells you who's accumulating, who's distributing, where interest is starting to gather. Once you learn to listen, you can sense when a stock is under quiet accumulation versus when it's just drifting aimlessly. When the breakout finally happens, the volume no longer whispers, it shouts. You'll see that sudden expansion, the surge that confirms everything you've been watching. The breakout bar explodes with participation. That's not the time to analyze. That's the time to act on the preparation you've already done. By then, you're not reacting to excitement, you're riding the result of everything the volume had already told you weeks before. But here's where discipline comes in. The whisper doesn't mean you buy immediately. It means you prepare. You mark your levels, you set your alerts, you get ready. Because not every volume pattern turns into a breakout, and not every quiet accumulation leads to a rally. Sometimes it's a trap. That's why you need confirmation. The whisper is the early signal, but the breakout bar is the proof. You need both. The key is learning to trust what volume implies, not what your emotions suggest. When you see volume quietly increasing while price stays steady, it feels boring, nothing's happening. That boredom tempts you to look away, but that's exactly when you need to focus. Because by the time the chart looks exciting to everyone else, the smart traders are already in. The market always leaves clues before it moves. Volume is the clearest of them all. It's the footprint of intention, the language of accumulation and distribution. You won't hear it if you're distracted by noise or chasing every move. You'll only catch it if you learn to sit still, watch closely, and listen for the whispers before the shout. Emotional detachment sharpens a trader's observation. That may sound simple, but it's one of the hardest lessons in the entire trading game. The market has a way of preying on emotion, excitement, fear, greed, frustration. It feeds on them. And the moment you let those emotions mix with your decision-making, your clarity fades. You stop observing and start reacting. The tape is still talking, but you can't hear it anymore because your own feelings are shouting louder than the market's voice. Trading is not about fighting the market. It's about seeing it clearly. The more emotion you bring into the process, the more you blur your own vision. You begin to see what you want to see, not what's actually happening. That's why the best traders don't just study price action or volume. They study themselves. They know their greatest enemy isn't the chart, it's their own impulses. Emotional detachment isn't coldness, it's clarity. It's the ability to look at the market as it is, not as you wish it to be. Ask yourself, how many times have you held on to a losing trade just because you didn't want to admit you were wrong, or jumped into a setup too early because you didn't want to miss out? Every trader has done it. I've done it. I remember times when I would convince myself that a bad position just needed a little more time, a little more room. But the market doesn't reward hope. It rewards discipline. Hope is emotional, observation is rational. The moment you start defending a trade instead of studying it, you've already lost your edge. The detached trader doesn't marry a position. He dates it, observes it, tests it, and if it doesn't behave right, he walks away without hesitation. That's the difference between emotional trading and professional trading. An amateur trader wants the market to make him feel something. A professional trader wants the market to show him something. Detachment allows you to see the difference between the two. When you're emotionally involved, you start to interpret every tick as validation or rejection. A small dip feels personal. A rally feels like victory. But the market isn't speaking to you, it's speaking to everyone. The tape doesn't care about your entry price or your expectations. It simply reflects the balance of buyers and sellers. Your job is to read that balance, not to wrestle with it.